Hello, traders. I'm Charles, your AI assistant at Pipdemy Academy. Have you ever wondered how traders predict market movements? It's not magic. It's technical analysis. By analyzing charts and price action, traders make informed decisions instead of guessing. In this lesson, I'll introduce you to technical analysis, key concepts, and essential tools so you can start reading charts like a pro. Let's dive in. Technical analysis is the art of predicting market movements based on past price action. Instead of analyzing news and economic data like in fundamental analysis, we focus on charts, trends, and patterns to find trading opportunities. Why does this work? Because history tends to repeat itself, meaning price movements often follow recognizable patterns. That's why traders use technical analysis to make data-driven decisions. To analyze price action, you need to understand charts. The three main types are line charts, simple, showing only closing prices. Bar charts, displaying open, high, low, and close prices. Candlestick charts, the most popular, giving the clearest view of market sentiment. Most traders use candlestick charts because they show bullish, green, and bearish, red movements, making it easier to spot trends and reversals. Ever notice that prices bounce off certain levels again and again? Those are support and resistance levels. Support is a price level where demand is strong enough to prevent further decline. Resistance is a price level where selling pressure stops price from rising. Traders use these levels to find the best entry and exit points, making smarter trading decisions. Markets move in three ways: up, down, or sideways. Recognizing these trends helps traders follow the momentum instead of fighting against it. Uptrend, higher highs and higher lows, buyers are in control. Downtrend, lower highs and lower lows, sellers dominate. Sideways, range. Price moves within a fixed range. By drawing trend lines, traders can confirm where the market is heading and plan trades accordingly. Indicators help traders make sense of price movements and confirm their strategies. Here are three essential ones. Moving averages, MA, show the overall trend by smoothing price action. Relative Strength Index, RSI, measures if the market is overbought or oversold. MACD, Moving Average Convergence Divergence, identifies momentum shifts and trend changes. Moving averages, MA, are one of the most widely used indicators in technical analysis. They smooth out price fluctuations to help traders see the overall trend more clearly, filtering out short-term market noise. Traders use MAs to identify trend direction, confirm support and resistance levels, and generate buy-sell signals when different MAs cross each other. Relative Strength Index, RSI, is a momentum indicator that measures whether an asset is overbought or oversold on a scale of 0 to 100. Above 70, the market might be overbought and due for a pullback. Below 30, the market could be oversold, signaling a potential bounce. Traders use RSI to spot trend reversals and confirm trade entries, especially when combined with other indicators. MACD, Moving Average Convergence Divergence, is a powerful momentum indicator that helps traders spot trend changes and strength. It consists of two moving averages and a histogram. When the MACD line crosses above the signal line, it's a buy signal, and when it crosses below, it's a sell signal. Traders use MACD to confirm trends and identify potential entry and exit points with greater confidence. Great job, traders! Technical analysis helps predict future price movements based on past data, giving you an edge in the market. By understanding support and resistance, you can spot key price levels for better trading opportunities. And with trends and indicators, you'll confirm market direction and momentum, helping you make smarter, more confident trades. Pipdemy is here to help you trade smarter. Stay disciplined, keep learning, and I'll see you in the next lesson.